From 2021, China's module production in the chart on the left-hand side has risen from 181.8 gigawatts in 2021 to 288.7 gigawatts in 2022, and almost doubling to 499 gigawatts in 2023. At the same time, solar installations in China have also increased.
First of all, there is a series of European climate neutrality targets by 2050, and the whole package of 25 directives under the umbrella of European Green Deal.
Among the many incentives introduced by the IRA was the domestic content bonus for those claiming the investment or production tax credits. This is a 10% tax credit adder for those who can show that 40% of the cost of their components is from American-made products. That requirement.
Good evening, and welcome to our webinar today about the global PV market trends, together with our guest speakers from Opus. As you have noticed, there's many changes in the PV market right now, and Opus will give you more insights about the Chinese, the European, and the US PV market. Then let me first explain you some practicalities of this webinar. This webinar will last about 40 minutes, and then we have a 15-minute Q&A. If you have any questions, you can type it in the chat box on your screen, and then after the presentations are finished, we will answer your questions. This webinar is also recorded, and you will automatically receive an email with the recording, and you can also review this webinar together with our past webinars on our website. Then let me introduce you to the guest speakers. So first we have Serena Zhang. Serena has already 15-year experience in the price reporting market and is now responsible for the Asian coverage of the Opus Weekly Solar Report. Then next we have Benita Dresen. Benita is a senior analyst and focuses on the European module market and has more than 20 years international working experience. Last we have Colt Shaw, who is also a senior analyst and focuses on the US. Colt also analyzes the tariffs in the US, which is now quite important. Then myself, I'm Benoit van der Maas, working at Sinovoltaics for 5 years, and I mostly help our clients in Europe to improve the quality of their solar and BESS projects. Then I'll give the word to Serena.
Thank you, Benoit. Hello, ladies and gentlemen. Thank you for taking the time to attend this webinar. My name is Serena Singh, Associate Director of Content APAC at Opus. On behalf of Opus, I would like to thank Sinovoltaics for giving us this opportunity to present. I would begin the presentation with a short introduction of Opus and the work we do in the solar space. This will be followed by an update on the Chinese, European, and US module markets. Opus started in 1980 in the US as an oil news service, and we started reg pricing in 1986. We launched spot pricing services in the US. In 2007 and 2008, we expanded our market coverage to Europe and Asia respectively. Opus was acquired by IHS Markit in 2016 and subsequently acquired by News Corp, the parent company of Dow Jones, in 2022. In the same year, Opus launched the Weekly Asia Solar Report. The report has since grown to include a global coverage of the European, US, and Asia markets. Opus is now part of the Dow Jones Group of companies. Familiar brands that you may have heard of that are also part of the Dow Jones Group includes Wall Street Journal, Barron's. Opus publishes the Solar Weekly Report every Tuesday. The report features spot pricing across the solar value chain from polysilicon to modules and includes a one-year forward pricing of modules on the FOB China, FOB Southeast Asia, and DDP US basis. Opus launched spot assessments of DDP Europe and US TopCon assessments in August this year. The report also includes weekly commentaries explaining the price trends, supply-demand fundamentals, news articles showcasing the latest developments in the solar market, as well as capacity updates. We will now look at the supply-demand fundamentals, regulatory policies, and what lies ahead in the Chinese module market. From 2021, China's module production in the chart on the left-hand side has risen from 181.8 gigawatts in 2021 to 288.7 gigawatts in 2022, and almost doubling to 499 gigawatts in 2023. At the same time, solar installations in China have also increased from 53 gigawatts in 2021 to 87.41 gigawatts in 2022 and 217 gigawatts in 2023. Exports of modules over the same period, denoted by the gray bars, have increased from 89 gigawatts in 2021 to 208 gigawatts in 2023. However, the surplus of modules, which is the calculation of production minus installations minus exports, have also been increasing year on year, rising from 14 gigawatts in 2021 to 74 gigawatts in 2023. In the first half of 2024, production volume stood at 271 gigawatts, installations at 102.48 gigawatts, and exports at 121.9 gigawatts. The surplus stands at about 36.62 gigawatts in the first half of 2024. The rapid rise in supply in the Chinese market has largely contributed to weaker module prices. According to OPIS historical price data, prices of mono-PERC modules have fallen 59.5% from 0.222 per watt peak in January 2021 to 0.09 per watt peak for China on October 2nd. TOPCon module prices have fallen 47.1% from July 2023, when OPIS first launched FOB China price assessments for TOPCon modules to reach 0.09 per watt peak for China on October 2nd. Looking at the chart on the right, production volumes of modules in China continue to remain robust in the first 9 months of 2024, reaching a total of 420 gigawatts. CPIA estimates that 2024 module production capacity will reach 600 gigawatts, an increase of 20.2% from 2023 levels. Module producers are expected to increase their operating rates in Q4 to try and meet their production targets for the year. But it remains to be seen if CPIA 600 gigawatt forecasted production levels could be met in the last 3 months of the year. There is now a production shortfall of 180 gigawatts from the 600 gigawatt forecast, which means that monthly production volumes have to reach 60 gigawatts in order to meet the forecast level. The anticipated additional supply coming into the market will further weaken prices. In the first 9 months of the year, OPIS monthly averages of mono-PERC and TOPCon module prices in September fell 20.4% and 23.1% from January levels of 0.09 per watt peak and 0.09 per watt peak respectively. I wanted to add a slide to show how prices across the solar PV value chain have been falling year on year amid oversupply. OPIS Global Polysilicon Marker, OPIS benchmark for non-Chinese polysilicon monthly average prices have fallen 21.3% year on year at 22.19 per kg in September 2024, while OPIS China monograde polysilicon monthly average prices have fallen 59.2% at 33.47 yuan Chinese yuan per kg or $4.73 per kg over the same period. TOPCon module FOB China monthly average prices have fallen 38% year on year at 0.093 per watt peak in September 2024. The chart on the left-hand side shows the total production volume of the top 5 Chinese module players from 2022 to 2024. The total production volume of top 5 Chinese module players rose 51.2% from 302 gigawatts in 2022 to reach 457 gigawatts in 2023, with jumps in production capacities of JA Solar and LONGi reaching 90% and 41.2% respectively. JA Solar's module production capacity reached 95 gigawatts in 2023, up from 50 gigawatts in 2022. LONGi's module production capacity reached 120 gigawatts in 2023, up from 85 gigawatts in 2022. The exponential rise in production capacity by the top 5 Chinese module players in 2023 partially contributed to the supply glut in the market, as China was producing far more modules than what its local market could consume. In 2024, based on company announcements and industry sources, the module production capacities of the top 5 module players were expected to see a moderate increase of 17.8% from 2023 at 509 gigawatts. Amongst the top 5 Chinese module players, Trina Solar and Jinko Solar are expected to increase their production volume by 27% and 44% respectively, while JA Solar, LONGi, and Canadian Solar are expected to see production growth of 5%, 6%, and 7%. I would like to mention that LONGi did not give actual 2024 production volume figures, but had announced that the module production capacity is expected to reach 150 gigawatts in the next 3 years from 2024, which for the purpose of comparing production capacity amongst the top 5 module producers, I'm assuming a yearly production increase of 7.5 gigawatts each year for LONGi from 2023. The chart on the right shows the total shipment volumes for the top 5 module players for the years 2022 to the first half of 2024. Although production volumes have increased year on year, top 5 module players' shipments have also increased over the past 2 years. In 2022, total module shipments of top 5 module players reached 194 gigawatts, while in 2023, total module shipments of the top 5 module players reached 209 gigawatts, an increase of 54%. In the first half of 2024, total module shipments of the top 5 module players reached 161.6 gigawatts, with Jinko Solar exceeding 40 gigawatts of shipments over the same period. We will first look at China's domestic policies, followed by the international regulatory policies impacting Chinese module trade flows. China has, in its 14th five-year plan, targeted a 50% increase in renewable energy generation to 3.3 trillion kilowatt hours in 2025. This was followed by China's national energy brew policies in July 2021 that required solar installation on 50% of rooftop space on party and government buildings, 40% of public buildings such as schools and hospitals, 30% of industrial and commercial spaces, and 20% of rural households. In the same year, China's State-Owned Asset Supervision and Administration Commission of the State Council, which manages state-owned enterprises, SOEs, announced a new requirement that central SOE power companies have at least 50% renewable energy capacity by 2025. The Made in China 2025 Master Plan rolled out in 2015 aimed to increase the Chinese domestic content of core materials to 40% by 2020 and 70% by 2025 in order to achieve independence from foreign suppliers. The initiative encourages increased production in high-tech products and services. All these policies have contributed to the rapid growth of the Chinese solar industry over the past few years. On the other hand, China started to phase out feed-in tariffs in 2018 due to high costs and challenges administrating the feed-in tariff programs, and had directed local governments to shift more solar procurements to competitive auctions. Feed-in tariffs remain for offshore wind and concentrating solar power, with the feed-in tariffs for these two categories set and paid for by provincial authorities. Earlier on July 9, the Ministry of Industry and Information Technology published proposals seeking public opinions on the regulatory conditions for photovoltaic manufacturing industry and administrative measures for announcement of photovoltaic manufacturing industry, imposing stricter requirements on PV manufacturing. One of the proposals was to raise the minimum capital ratio for new construction and expansion of photovoltaic manufacturing projects to 30% from 20% previously for wafer, cell, and modules production. Industry sources think this adjustment is a measure to curb investment impulses amid the oversupply in the market. Amongst the other proposals, MIIT guide photovoltaic enterprises to reduce photovoltaic manufacturing projects that simply expand production capacity. On the international front, there has been an increase in import tariffs and regulatory policies impacting Chinese module trade flows. Besides India's ALMM and US Section 301 tariffs and the removal of Section 201 bifacial module exemption starting in January of 2024, the Brazilian government announced that it is reintroducing a 10.8% import tax on Chinese solar panels. South Africa announced a 10% import duty imposed on solar photovoltaic PV panels, cells, and modules in June this year. Chinese trade flows remain concentrated in Europe, which remains the largest importer of Chinese modules. Europe imports of Chinese modules stood at about 67 gigawatts in the first 7 months of 2024, down 4% from 2023 due to the Red Sea crisis, which had led to delayed shipping time of imports and destocking of European inventories. Asia imports stood at about 46 gigawatts, up 98% from 2023. The Middle East is fast becoming one of the key importers of Chinese modules at about 18 gigawatts, up from 7 gigawatts in 2023. China has increasingly turned to other countries such as Pakistan, who imported about 13 gigawatts of Chinese modules in the first 7 months of this year, and Australia at 3.7 gigawatts over the same period this year to build up new export regions. In conclusion, record low Chinese module prices and fierce competition amongst Chinese module sellers are here to stay. As supply continues to outweigh demand, a price war amongst module sellers are expected to result in record low profit scenario, leading to a survival of the fittest situation amongst the module sellers. Smaller module players who cannot compete will start to exit the market. The Chinese sales industry has started to see a market consolidation, and it is a matter of time before the module segment undergoes a consolidation. Amid an environment of low profits, module sellers will focus on cost-cutting innovation to stay competitive. Large vertically integrated module manufacturers will have a cost advantage as they are able to control production costs across the value chain. On the international front, Chinese module players have a cost advantage as according to the IEA, the cost of manufacturing a PV module from polysilicon to finished panel in 2023 compared to China was estimated to be about 10% higher in India, 30% in the US, and 60% higher in the European Union. These differences result from higher investment, labor, and energy costs, as well as lower scales of production and a lack of vertical integration. By 2028, these differences could grow to 70% in India, 100% in the United States, and 140% in the European Union, according to the IEA. The IEA also estimates that the cost to replace Chinese PV modules with more expensive domestic manufacturing over 2023 to 2028 period is expected to reach $12 billion in the US, $8 billion in the European Union and India. These estimates assume capacity utilization factors of over 70% for planned manufacturing plants across these countries, which should allow them to operate efficiently. In terms of innovation, Chinese module players will continue to invest in technology advancements. According to the China Photovoltaic Industry Development Roadmap, compiled by the China Photovoltaic Industry Association, the market share of N-type TOPCon cells rapidly increased from 33% in 2023 to 60% in 2024. It is expected that the overall market share of N-type modules will reach 73% in 2024. Chinese module manufacturers will continue to focus on technological advancements and breakthroughs to stay ahead of the game. With this, I conclude my presentation. I will now pass the microphone over to my colleague, Benita.
Thank you very much, Serena. My name is Benita Dreesen. I'm working for the Opus team in Europe. And the idea today is I give you a little overview of the situation of European solar market today and for the next couple of years as well. So as we can see, and as Serena also mentions, is that the global solar market is doing well. European is doing well as well, because solar installation reached a record level in 23 overall all over the world, in Europe, China, the US. In Europe alone, already installed 61 gigawatt in 23, those are figures of 23, up 40% year on year, and for the third consecutive year already. This growth is led by companies such as Germany, Spain, Italy, Poland, and the Netherlands. And Germany alone, for example, installed 14.1 gigawatt of new solar energy in 23. Followed by the other countries. So there is growth. What do we see for this year and for the coming years is that the growth will continue, but there's a little bit slowdown in the growth rate, 11%, which is still growing, but not at the 40% we saw previous years. The analysts say that solar capacity in Europe is expected to continue its upward trends, nevertheless driven by ongoing regulations, decarbonization efforts from Europe, of course, energy security concerns, which are very important, and increased demand for both residential and commercial sectors. On the left side, you will see the pie chart showing the three different equal distribution, I see, across the utility scale, commercial, industrial, and residential segments. Important to notice is that 2/3 of the new installations in 23 were for self-consumption. This means that there was no grid connection needed. And why is that? Because on the right side, you see the bar chart that shows the challenges, and the challenges impacting solar growth are a slow grid expansion. There is an issue with that. Permit delays, high interest rates, and lagging storage systems. Those are a few of the challenges. But the growth is mainly due to the fact that there are, as we said already before, a lot of regulations, regulations around climate goals with their targets. And there are a lot of regulation within the EU. First of all, there is a series of European climate neutrality targets by 2050, and the whole package of 25 directives under the umbrella of European Green Deal package. Those are climate regulations. They have been shaped already since 2018 by Europe's broader renewable energy policy, which came before. Since 2019, we have this 25 Green Deal directives, and the Green Deal has set climate neutrality by 2050, particularly solar will play an important role. And the EU says, okay, that we need to increase solar PV capacity to 600 gigawatt by 2030, which would estimate probably an investment between 22 and 27 by some 26 billion of euros. So after this Green Deal, we have, of course, the European energy dependence rules. As we all know, the Russian-Ukraine conflict has made it clear for Europe and European Commission that we should focus on energy independency, accelerate a shift away from fossil fuels into renewables. And in Europe, within the wind and the solar takes the biggest part. So the EU aims to replace Russian gas as soon as possible by renewable. So has developed quite some goals and quite some rules as well. We have the Temporary Crisis and Transition Framework called TCTF, also the Recovery and Resilience Facility, RRF, and altogether huge budgets, but they are mainly funding for CapEx. It's mainly CapEx funding. Then we have a big rule, a big important one, Net Zero Industry Act. Everybody in the, I would say, in the market talks about it. It was set up initially. It was Europe's response to the inflation, U.S. Inflation Reduction Act, which called in U.S. We'll explain a little bit more about it. Only the Inflation Reduction Act has a budget of $5.6 trillion. The net zero industry a little bit less, but nevertheless, Europe has set targets for manufacturing of clean technologies in the EU, saying that the goal is to have a share of 40% share of EU production to cover EU needs for clean technologies and components by 2030. So that is a very big goal, very important goal. Apart from the Net Zero Industry Act, and I'll come back to that a little bit later in my presentation, we have, of course, the National Recovery and Resilience Plans, again, mainly subsidizing the CapEx costs, and those kind of funds are disbursed to the national governments, I would say, in forms of loans and grants. So if we look at that, those were the European regulatory, these are the national policies. The national policies, you will see that there is really a big, an overview of tax schemes, subsidies, benefits, feed-in tariffs, etc., which are changing or which are different between the European countries. You can see it here. For example, many countries, they all set aggressive goals. Germany said, okay, 215 gigawatt by 2030. France tries to quadruple its solar capacity also by 2030. So those are important targets. And they are, of course, need to be backed up by incentive schemes such as the feed-in tariffs, which you will see here, subsidies, tax benefits for solar installation, and so on and so on. Again, it's a pity because most of those tariffs are around CapEx and not so much around OpEx. You will see also in the chart that Germany leads with 1.5 billion in subsidies, follows very closely by Italy, Spain, France, and the other company and the other regions. Italy, for example's Transition Plan 5.0 provide resources of around 6.3 billion euro to be used in 24 and 25 for solar. The Made in Europe bonus in Austria, which has been approved not so long ago, says that applicants could receive a bonus for up to 20% of their investments, the CapEx investments. So a lot of different schemes within European countries. So those are the idea is really to drive the European market, but not only the import market, but mainly the European made in Europe manufacturing markets, because you will see that European global solar market is doing well, but the manufacturing market is in very much difficulties with many bankruptcies over the past years. You will have noticed this probably as well. I should mention that European manufacturing market, once led by France and then afterwards by Germany, is now nearly gone and needs to rebuild up again nearly from scratch. So, for example, in 2018, the EU predicted that PV manufacturing in the EU would be around 11 gigawatt in 2023. As we see the situation today, half 24, we see that only two, others have 5, but 2 gigawatt of PV modules are actually really produced in the EU in 2024. So it's a far cry from the 11 gigawatt. And one of the reasons for this market situation is, of course, that European manufacturers, as Serena already mentioned, stippled out, that there are enormous price challenges with very low prices for imported Asian PV modules. And why is that? Because, of course, the Asian Chinese prices are the result of economies of scales, of low labor costs, government subsidies, low energy costs, which we don't have yet in Europe. Analysis for the EU industry estimate that production costs for module manufacturing in the EU are 105% higher than in China. Now, Sylvain just mentioned the EIA, who stipulates 140%. It's even the gap is even more bigger than that. But furthermore, there is really a very big difference between the prices for imported modules and for prices between in Europe for European manufacturing. So we have, first of all, the price gap. Opus Europe assessed that imported modules for TOPCon prices are around 10 cents per watt peak, euro cents per watt peak. Would it be made in Europe? We are around 30 to 40 cents per watt peak. But apart from the addition, I would say, from the price challenges, there are other challenges as well. For example, supply chain disruptions. Many EU manufacturers, of course, depend on imported raw materials and other materials, such as polysilicon, who very much come from the Asian regions. With a European market that is so in distress, I would say, it is difficult to find financing and investments initiatives, of course. And then we have the fragmented market with diverse national policies, incentives, regulatory environments that complicate doing business in one European country, and even more complicated doing operation and businesses across multiple European countries. So a lot of challenges. But in the meantime, the European manufacturer and European Commission as well understood that we need to build up a European market, European manufacturing market. So there are a lot of initiatives. One initiative is, for example, European Product Portfolio Label, DPP, launched a few weeks ago, officially launched a few weeks ago, endorsed by European solar manufacturers and by the Solar Power Europe. It is an independent and private initiative. And the reason for it is because the market says, okay, we have the Net Zero Industry Act, but it will be implemented, and we will see the first result probably in 27, 28. For subsidy-wise. And in the meantime, we need to fill this price gap of 20 cents per watt peak. So one of these initiatives is this one, the DPP. There are others as well. And the idea is to make the bridge between them. And how does it work? Well, it works on the basis of a free membership. So a company can become free member. But on the other side, it needs to commit itself that, for example, it would take in 5% of their total sales portfolio must be made from domestic PV modules. 27 years later, it should be 10% of what they sell should be domestic or European-made PV modules, and it goes on until the price gap between imports and European-made is narrowed, and DPP expect that it would be around 28. If we look in a conclusion for the European market, we could say that European market, the solar market, is growing, but the manufacturing market is in deep trouble. Again, Germany is expected to remain the largest solar market in Europe because it has set very ambitious renewable targets. Spain is expected to grow rapidly as well, thanks to its abundant solar capacity. It has a lot of solar and also its supportive governmental policies. We expect that there will be, you will see it already in the market, there is a growing trend to integrate solar PV installations with energy storage solution. And the reason, therefore, is to enhance grid stability and reliability. And grid stability, giving back renewable power to the grid, is an issue. For example, in the Netherlands, where they are already now discussing and approved also the net metering system. We have, as I mentioned, ongoing supply chain issues, availability of polysilicon, other raw materials. This will continue to impact manufacturing timeline and costs as well. The changes in national policies in grid connection issues, local permitting creates other challenges. So we would say that the European solar manufacturing industry needs to reinvent itself. A lot of, for example, 2 weeks ago, there was a PV-SEC Congress or event. A lot of people talked about their, get focused on innovation, get PV out of the lab and back into the field again by testing. We need to see new application, new innovation, PV everywhere. And today research is the only way, research and very niche way of doing solar PV manufacturing is the way to make forward and to achieve for Europe, European industry, a very solid industry that aligns with energy security from one side and economic growth targets on the other side. And that was my conclusion. Colt, up to you again. Thank you.
All right, thanks, Benita. I want to start our look at the U.S. market with current pricing trends, but first we need to understand what drives those trends. In the U.S. solar industry at the moment, there are two camps playing a game of policy tug of war. One camp is made up of domestic manufacturers and their supporters who would like to see a robust green industrial sector and the government incentive to make it happen. Another camp is solar farm developers and their supporters who have pushed back on recent tariff investigations into module manufacturers in China and Southeast Asia, believing the cheaper imports are key to keeping up an unprecedented pace of project development, tackling clean energy targets, and climate change. This game of tug of war can be traced through pricing trends. The latest AD/CVD tariff investigation into 4 Southeast Asian countries, responsible for 75% of imports to the U.S. in 2023, kicked off in April, and June brought the end of a 2-year tariff holiday. Now, after a 2-year price slide from around 45 cents a watt in 2022, the average price for mono-PERC modules DDP US has been steadily creeping up again. Opus is currently assessing the price at 28 cents a watt for delivery in the first quarter of 2025. The premium American customers pay is clear when you look at prices for modules shipped into Europe. We're currently seeing spot prices of around 10 cents a watt for TOPCon modules DDP EU, just above the average price for modules shipped FOB from China. Customers in the U.S. are currently looking at a spot price of 29 cents a watt, with prices creeping into the low 30s in early 2025. As you can see in the chart to the left, the spread between FOB China prices and DDP US prices have been increasing since the spring from around 16 cents to about 20. Opus will have more visibility into the U.S. domestic market as more module plants come online next year in the U.S., but indications are starting to arrive. Companies with vertically integrated supply chains in Asia have quoted prices for domestic-made modules that are just a few cents above their imported offerings, but using foreign cells. On the other hand, a market source indicates that there are offers as high as the 40 to 60 cent per watt range for domestic modules with mostly domestic components to be delivered in the spring. The higher end of this range is seen as unrealistic and will likely drop as 2025 progresses. The obvious price disparity raises the question of why a customer would choose US-made modules over cheaper imports, which is a question the American government has been trying to answer in recent years, most notably with the passage of the Inflation Reduction Act in 2022. Among the many incentives introduced by the IRA was the domestic content bonus for those claiming the investment or production tax credits. This is a 10% tax credit adder for those who can show that 40% of the cost of their components is from American-made products. That requirement jumps to 45% next year, 50% in 2026, and 55% in 2027. The IRA also introduced the new manufacturing tax credit and revived another, with both meant to spark the build-out of the American solar supply chain. The Department of Energy set aside $10 billion in funds for the revamped Advanced Energy Project Credit, also known as 48C. For those that meet prevailing wage and apprenticeship requirements, the tax credit could be equal to 30% of qualified investment costs for projects, according to the DOE. The new Advanced Manufacturing Production Tax Credit is a statutory credit and is earned over time based on production of eligible components, but that will be phased out at the end of the decade. But we've started to see a few manufacturers monetize these to pay down debt or invest in their own growth. These incentives have been remarkably successful thus far in promoting the development of the module assembly plants in the U.S. According to Opus data, there was a total production capacity of 7 gigawatts of crystalline silicon solar module production in the U.S. at the end of 2023. And by the end of this year, there will be 49 gigawatts. And by the end of next year, there will be around 60 gigawatts. Just an interesting side note, roughly half of this capacity is projected to be owned by companies based in China. Cells and wafers are seen some growth, but have not kept pace with announcements for new module plants. There was no significant cell or wafer production capacity in the US at the end of 2023. By the end of this year, there's expected to be nearly 5 gigawatts of wafers and 8 gigawatts of cells. And there's been just one new polysilicon plant announced in the US. In the coming years, Highland Materials will open a production facility in Tennessee, adding 10 megawatts to the 20 megawatts of polysilicon production already operational in the country. It's not all bad news for the US. According to the high-level analysis by Opus, despite higher processing costs, US-made wafers could be cost competitive with Chinese, non-Chinese polysilicon, thanks to the domestic content bonus subsidizing the former and tariffs imposed on the latter. Despite this, the disparity between modules and wafers and cells means US manufacturers will continue for some time to use upstream components imported from Asia in order to finish modules stateside. The federal government acknowledged this shortfall in August when they raised the annual tariff rate quota for PV cells from 5 gigawatts to 12.5 gigawatts, citing domestic modules manufacturers' continued reliance on imported cells to keep their production lines moving. In the current AD/CVD case, preliminary countervailing tariffs were announced on October 1st, and the Department of Commerce upheld the critical circumstances allegation, meaning the tariffs will be applied retroactively going back 90 days or to the beginning of July. The company-specific subsidy rates range from 0.14% for Trina and 0.85% for Boviet, both of which were considered de minimis or trivial, to 2.85% for JA Solar subsidiaries and 14.72% for Hanwha Qcells Malaysia. Some rates as high as 292% were dealt to smaller companies deemed non-compliant in the probe. For non-specified companies, the DOC placed subsidy rates ranging from 2.85% for Vietnam to 23% for Thailand. The more substantial tariffs are still to come, as the preliminary determinations for anti-dumping were pushed back to November 27th. For comparison, the charts to the right show the alleged dumping rates in the current probe and the final rates from the previous tariff circumvention case. There's obviously some history here. The US has since the early years of the last decade used tariffs to try and combat China's domination of the global supply chain. The Obama administration, following an AD/CVD investigation, imposed tariffs of between 24% and 36% on suppliers in the country early last decade. In 2018, the Trump administration applied a 25% tariff on all solar cells produced in China, whether or not assembled into modules. Biden extended this tariff and this year doubled it to 50%. So far, these tariffs have mostly succeeded in forcing Chinese companies to move their cell and module plants to countries in Southeast Asia in order to continue selling to the US market while continuing to use polysilicon in wafers from China. But US customers no longer buy modules from China in any significant numbers, making the new rate largely symbolic. And already the most current AD/CVD investigation has led companies to consider Indonesia, Laos, India, the Middle East, and elsewhere as potential new locations for their operations. But nothing is set in stone. Opus learned during the REI conference in India last week that quite a few Indian module manufacturers are now turning away from the US market, citing the heightened risk in supplying it. US trade officials, in confirming the new rate last month, also made a gesture towards the ongoing game of tariff whack-a-mole by proposing that Chinese polysilicon and wafers be subject to the same 50% tariff, which could cause manufacturers to rethink their supply chains altogether. Towards the conclusion, looking ahead to 2025 and beyond, solar will continue to grow in the United States, but at a more modest pace than once expected. The residential, commercial, community, and utility scale sectors all face unique headwinds. 2023 was the biggest year for solar installations in the United States to date. Every sector put up record numbers, according to a report from SEIA and Wood Mackenzie. Overall installations increased by 51% between 2022 and 2023. But now overall installations are expected to decline 4% in 2024 and grow at a rate of just 4% from next year through the end of the decade. And the challenges driving that depressed outlook are numerous. California, the largest market for residential solar, cut net metering last year, taking the legs out from underneath that sector. High interest rates have also played a role in dampening consumer demand. And in the second quarter, residential installations were down 37% from last year. SunPower, a longtime leader in the space, filed for bankruptcy in August. Maxeon, the module manufacturer spun out of SunPower a few years ago, canceled its financial forecast for the rest of this year, as all of its shipments from Mexico into the US have been detained at the border indefinitely. Shipments of modules idling in warehouses for months at a time can throw project timelines into disarray and make investors squeamish. Perhaps most pressing, interconnection queues are clogged across the country, delaying pre-development timelines. Legacy electrical grids and their interconnection processes were designed to accommodate a few large fossil fuel-fired generators located close to population centers. The renewable energy transition has flipped this arrangement on its head. Solar farms and wind farms are typically lower capacity and require more land, complicating the study process and prompting the need for massive new transmission projects to welcome the new capacity. Regional transmission providers are scrambling to retool and modernize their approach and slowly working through backlogs of projects waiting to start producing energy. Developers are also contending with equipment and labor shortages, increased public hostility and protests at the local level, and policy uncertainty, especially with the presidential election a month away. Given all of this, the module market is quiet at the moment, with demand slowing and customers in wait-and-see mode. Still, as you can see in the charts to the left, solar power represented 67% of all new electricity added to the American grid in the first half of this year, up from 53% last year and 40% in 2019. The federal government has repeatedly, through word and policy, signaled its support for the industry's continued growth, and states have set ambitious targets of their own. Momentum is on solar side in the US. And that's all I have today. I will hand it back over to Benoit.
Hi, Cole. Thanks a lot. This was very interesting. So now we've seen all the presentations from Opus, and with all these price fluctuations and demand and supply fluctuations, I will let you know how we can prevent quality fluctuations during these times. So I will talk about three major topics. So first of all, the contracts, then the certified materials, and 100% inspections. First, let me give a brief explanation of what Sinovoltaics does. So it's basically divided in two parts. One is quality, one is traceability and ESG. So for quality, we offer inspections and audits for all PV and BESS components. And with our special services, we also provide 100% inspections. Then for traceability and ESG, we offer ESG audits, supply chain mapping audits, and manufacturing order tracking for the UFLPA. First of all, the contracts, because sometimes if the prices are changing, the supplier also wants to change their contracts. But if you have a strong contract, you can make sure that this isn't the case. So the contracts are the starting point of keeping your quality at the right level. And with price fluctuations, you want to make sure that you're covered. In the contract with your supplier, the commercial clauses are very important. For example, what happens if your shipment gets detained by customs or when you suddenly have to pay import tariffs. For the technical clauses, there's three important parts. One, the inspection procedures. You want to make sure that all necessary elements can be inspected. Then the quality standards. These define what is accepted and what is not. This needs to be crystal clear. And then the sampling level and AQL, which defines how many defects in your order is acceptable or when is your batch rejected. A last part are the traceability clauses, because if you want raw materials to originate from specific countries or not from specific countries, you need to make sure that this is clearly written in your contract. And Sinovoltaics can help you with that. Then the next part is to use only certified materials, because you should only accept modules
Benoit, I think you're on mute.
Still having trouble hearing you, Benoit. It could be on my end, Benoit. I think still having an issue hearing you. I don't know if it's on my end at this point, but yeah.
No, I can't hear you too, Benoit. Sorry for the technical glitch. Please bear with us. Benoit is joining the webinar.
Can you hear me now, Serena?
Yes, we can hear you now.
Yeah.
Thank you. Well, we don't have so much time anymore, but yeah, let me just explain about the 100% inspection. So sampling might be good to get an idea about the quality, but if you want to be 100% sure about your quality, you need to inspect 100%. So at Sinovoltaics, we can do this with our Selma software, where we check all the EL images and we can reject any non-conforming modules. It is very fast, very accurate, and quite cost-effective. And on the next slides, you can see where we're located around the world. So we're everywhere, but mostly in Asia, and we serve clients all over the world. Then let's go to the Q&A. So I see a lot of questions about people that cannot hear me. Hopefully it's fixed now. So maybe let's go to the first question from Stefan. So China exports to Europe. How much is for the EU and how much is for other European countries? Maybe Benita, do you know or Serena, do you know the answer on that?
So on my side, I have the combined number for the first 7 months of this year, which is about 67 gigawatts. But in terms of the exact country breakdowns, perhaps I can get back to you, Stefan, after this webinar.
Maybe I can add to what Tirina is saying is that we have been looking for import figures, and it's very difficult to have import figures for Chinese modules. But what I know is that since as Colt explained, since the ban or the barriers put on by the US for imported solar modules, much more flow is coming into Europe than a year ago, I would say. Not only from China, but also from India. So that's the situation today.
Thank you, Benita. Then let's go to the next question. I think this is for Serena. So would it be possible to repeat the info about the cost of production difference? Like in India, the cost of production is 10% higher than in China.
Yeah, sure. So based on IEA estimates, compared to China, it's about 10% higher in India, 30% higher in the US, and about 60% higher in Europe in 2023.
Okay. Thank you, Serena. Then the next question from Francisco. What about Chinese stored stock in Europe? Less than 80 gigawatts stored all across Europe because the Suez Channel issues?
Well, I can answer that. Yes, the market has explained or have made an assessment that around 60 gigawatt of modules would be stored in European inventories. The inventories are since a few months since the start of this year lowering a little bit, but nevertheless it's huge. It's still huge. It's nearly, as they say, it's nearly the same that the total of modules that come into the country to the country into Europe. So imports and inventories would nearly be the same, but again, it's difficult to have exact figures for importing modules at this moment. But it's an issue. The stocks are an issue, yeah, because they are huge.
Okay, perfect. Thank you, Benita. Then another question, I think, for Serena. The start of market consolidation in China, really?
Okay, so just to reiterate on what my presentation. So the market consolidation that we are starting to see is in the sales segment. We have not seen market consolidation in the module segment at the moment. So for example, in the sales segment, we have heard in August this year, Linda Group has actually terminated its investment in a 20 gigawatt high efficiency cells production facility in Tongling. In the same month, the company has also filed a notice on the Shenzhen Stock Exchange that is at risk of going bankrupt and will need to undergo a reorganization. And in terms of other bankruptcies that's happening in the cell segment, there's another Chinese-based company called Yangzhou Bajie New Energy Technology Company, which is a subsidiary of Bajie Company. It has actually filed for bankruptcy reorganization in August as well. So what I wanted to say earlier in my presentation was that if the sales segment is really starting to see market consolidation, it is a matter of time that the module segment will also start to see one.
Okay, thank you, Serena. Then let's go to another question. We get a lot of questions now. So one question maybe for Colt. Why is the US rooftop market not growing?
So, I mean, part of it is just lowered interest rates, or I'm sorry, higher interest rates. And as you can see, like I pointed out, the drop or the cutting of the net metering law in California last year took the legs out from underneath the industry. I think a lot of it too is just people aren't seeing the returns that they were promised over the last kind of 20 years of rooftop kind of residential solar is part of it. I think there's also just perception around the industry, the kind of door-to-door salesman kind of culture around residential solar. That's maybe more of a kind of non-quantifiable aspect, but just generally, we've seen a lot of market leaders kind of close their shops, yeah. So it's not going away entirely. I think it's just in a period of kind of contracting or kind of right sizing, and I don't think it's going to collapse entirely, but just generally, it's been facing a number of different headwinds and is just kind of taking a backseat at the moment, and will likely kind of recover in 2025 going forward. Yeah.
Okay, thank you, Colt. Then maybe another question for you from Stefan. So the US Department of Energy subsidized the refurbishment of old nuclear power stations. Is this atomic energy policy damaging the PV growth in the US?
No, I don't think so. One, I think the conversation is just starting, and I think any significant kind of reuptake of nuclear energy in the U.S. is probably a ways away. But I think it generally poses a greater risk to natural gas and other kind of baseline generation sources. That's generally what it's kind of seen as a replacement for, and I think solar and battery storage combo kind of fits nicely with nuclear generation as well. So no, I think it's kind of more of a threat to kind of traditional generation sources.
Okay, thank you, Cole. Then I think this one is a question for Serena. Do you think there will be a fourth quarter installation boom in China again this year?
Based on my interactions with the market sources, they do believe that they will see another installation boom in quarter 4.
Okay. And then another question from Alfredo, also about the situation in China. So Alfredo is asking, what is the domestic demand from China?
Are you referring to the installations? The solar installation as a domestic demand?
I think, let's say yes.
Okay. If yes, then in the first half of 2024, the China installation was about 102.48 gigawatts in the first half of 2024. In 2023, it was about 217 gigawatts.
Okay. Thank you, Serena. Then I think there's another question for you. So when do you see the price recovery of Chinese solar modules pricing in Europe? Wait, you're on mute now, Serena.
Sorry. First, I need to clarify that OPIS, we are a price reporting agency. We do not do price forecasting. So I won't be able to, share with you when are we forecasting the market to stabilize. But when do we expect to see price recovery of Chinese solar module pricing in Europe? I think maybe Benita could answer this on the European side of things. You're on mute, Benita.
Can happen.
We have a mute problem today. Now, on the imported solar, Chinese solar or Indian solar modules, the European market doesn't expect immediately price increase. We expect that it will be stabilizing. Don't forget that we are still with overstock capacities, with a lot of inventories, which are dead money. In fact, this need to be solved as well. No overstock. On the other side, European module manufacturer made in Europe is really doing its best with a lot of initiatives. I mentioned one, the DPP, but there are other initiatives who say, okay, let's subsidize the price difference, let's innovate, let's see how much we can automate to reach nevertheless, not immediately those prices, but within now and a few years ahead, to come to a price difference from only 10% or 15% price difference. So that's from European side point of view. That's what we are looking at, a price difference of 15%. That's what the market is expecting today.
Thank you, Benita. Then we have another question from Ian. So what signals are you looking for to indicate the oversupply situation in China will have been corrected and the number of bankruptcies? And is there an increase in domestic demand?
I think fundamentally the issue now in the Chinese market is just overproduction. So as long as the production volume is falling below to where the demand levels are more or less being met, I would think that would have been a signal that the oversupply situation in China have been corrected. Are suppliers retiring an amount of sorry, Bernard.
No, go ahead. Yeah.
In terms of our suppliers retiring an amount of capacity, I think based on CPIA latest forecast, N-type TOPCon cells would constitute about 73% of the market in 2024. So definitely per capacity is getting phased out in the Chinese market.
Okay, thank you, Serena. It seems that there's a lot of questions for you. Then we have a next question from Sarmi. So does the new policy from China concerning the new tax has any impact on the module prices?
Are you referring to the MIIT's latest proposal? If so, then at the moment, by speaking to the market sources, we are not seeing any direct impact on module prices at the moment. But however, some module manufacturers that I'm speaking with are saying that this could actually, take about at least 6 months to see any impact on the market price.
Okay. Thank you, Serena. Then I have a question here from Stefan. The EU 2 gigawatt module per year manufacturing capacities. What are the names of these manufacturers? So actually, Sinovoltaics makes quarterly reports on the supply chain. We call it supply chain maps. One of those is also from Europe. So you can download it from our website and there you can see all the suppliers in Europe.
Yeah, but I think that's an easy one. I can so the 2 gigawatt module per year manufacturing capacity. So we have in Europe basically today the carbon giga, 1 gigafactory, and another gigafactory is Holosolis, who will become online in 25, 26 probably. We have in Poland a gigafactory coming up for the next year, and that's a little bit the capacity that we are expecting between now and the 3 years to come for PV manufacturing.
Thank you, Benita. Let's go to the next question. I think we cannot do that many questions anymore because the time is running out. Maybe from Tobias. Tobias is asking, is it true that CATL is looking to buy a panel manufacturer? I think I saw it in the Opus report, Serena, that CATL was planning to, or that there were rumors that they would buy DAS Solar, but right now there's nothing confirmed yet.
Yes, we have not heard any confirmation.
Let me check. Maybe the last question.
I'm sorry, Bernard, we are just losing sight of you. Have you switched off your camera or?
No. Can you still hear me, Serena?
Yes, I can hear you, but we can't see you.
Okay. I don't know why, but I think yes, a lot of questions, but the time is running out. So we have received all your questions, and I will share them with the Opus team, so we can still reply you email on your questions. Then I would like to very much thank Serena, Benita, and Colt from Opus for joining us at this webinar with all the interesting information. And also, I would like to thank all the attendees, and we will get back to you with your questions. And I wish everybody good day, good night, and
Thank you.
see you in our
Thank
next
you.
webinar.
Thank you, everyone.
Bye-bye.
Thank you, Bema.
Bye.
Bye-bye.
Visit Sinovoltaics.com to learn more.